Great. So now, on a similar note, to an even sexier topic would be the sort of the accounting considerations that these companies need to take into
accounting
account.
is sexy.
Accounting is very sexy.
Yes.
And so, what are some of the accounting items, the accounting initiatives that you need to keep in mind still during that pre-acquisition? A lot of these things tend to sneak up on you once
Yes.
close actually occurs. So what are some things you need to keep in mind there?
Okay. One that it's accounting kind of sort of not is tax. You really want to look at the tax of the acquisition, how the IRS is going to look at the acquisition. Are you buying the assets? Are you buying the stock, which means you're bringing the liability over? So how are they looking at that? Are there any NOLs, net operating losses, that you could actually acquire and bring forward? Another thing, obviously, your basic accounting is when I buy your company, we're going to step up the assets to market value. So if the assets at market value are greater than the liabilities, you're going to have goodwill. So then the goodwill sits on the balance sheet. The interesting thing, though, is you could end up with intangible assets on your balance sheet as the acquirer that the target company didn't have. So, for instance, customer lists and customer relationships and things like that, you can place a value on. Well, the target never put it up there because it was just ongoing. But that's one of the reasons that you're acquiring them, is for that customer list. So that becomes an intangible asset that you place up on your balance sheet. And obviously, it gets amortized over time and your net income goes down, but it's a non-cash item. But there are those accounting pieces that have to look at and say, okay, we're going to have some liabilities or we're going to have assets on our balance sheet that we're going to have to write off over time. Another piece that has just come out through AICPA FASB is, if you're buying a SaaS company, you have to look at their contracts as if you took the contract from day one, not from the point of time that you acquire the company, but all the way back. And you have to look at each of the contracts, both through 606 and say, what would it look like for us now? That can, with deferred revenue and all, you could end up with a large deferred revenue piece. So you're going to get revenue, but they've already paid it, right? So you're not getting the cash. So if I've got $2 million of deferred revenue that I get to bring over, that's great from an accounting perspective. I'm going to bring it in over the next year. So I automatically, day one of acquisition, I get $2 million of a bump up in revenue, but I get no cash. But I still have to support that customer. So you have to think about that. And then from a goodwill perspective, you can, as a smaller company, decide that you want to amortize that goodwill over 10 years versus looking at, looking at it at balance sheet dates to say, has there been an impairment? So those are the big things. It's all mostly around customer and, what are the costs of the values or the assets coming over.